Dubai International Airport, March 27th, 2026. Thomas, a British investment banker, stares at a departures board painted entirely in red. You're looking at the world's busiest international airport at 40% capacity. Since Iran started striking Gulf states on February 28th, drones have hit this exact airport 4 times. British Airways cancelled all flights through the end of May. Lufthansa, Air France, KLM, and Singapore Airlines are completely gone. Thomas bought a luxury off-plan penthouse last year. He bought into a simple pitch sold to the world for 20 years, promising zero taxes and the safest environment in the Middle East. That pitch died 2 weeks ago. The hub that once connected 3 continents is barely functioning. Thomas cannot fly out, and worse, he cannot extract his wealth. A missile strike just set a major shipping dock on fire, paralysing a business zone that makes up 36% of the city's economy. The fallout from this empty terminal is about to hit global gas prices, grocery bills, and retirement accounts. Now, before we dive in, this is history unfolding, not financial advice. Do your own research. The myth of the untouchable desert fortress has shattered, and $6 trillion in capital parked on that promise is looking for the exit. The first thing that died was not confidence, it was trade. On the morning of February 28th, an Iranian missile intercepted over the port of Jebel Ali sent debris crashing into a dockside berth and ignited a fire that DP World could not contain. The port suspended operations within the hour. What most people watching the news did not realise was the arithmetic hiding beneath that single sentence. Jebel Ali, together with its adjacent free trade zone, accounts for 36% of Dubai's GDP. Shut it down, and you have not inconvenienced a city. You have severed its spine, but the port was only the beginning. 240 miles away, at the narrowest point of the Persian Gulf, something far larger was happening. Iran formally declared the Strait of Hormuz a conflict zone and warned all commercial shipping to stand down. Ships carrying crude oil, liquefied natural gas and container cargo froze in place. Not metaphorically, physically. Satellite tracking showed hundreds of vessels at anchor, engines idling, waiting for a signal that was not coming. The strait is just 21 miles wide at its narrowest. A complete cessation of oil exports from the Gulf region amounts to removing close to 20% of global oil supplies from the market, the majority of which is shipped to Asia. For decades, analysts had called its vulnerability the world's most dangerous single point of failure in global energy supply. The same people who built Dubai's skyline, sold its apartments, and flew its airlines had spent 20 years insisting it would never actually close. It was closed, and every economic model in the world had to start again from zero. Dubai does not have a population. It has a temporary arrangement. Of the city's residents, approximately 88% are foreign nationals. There is no other major financial centre on Earth where that number applies. In London, it is around 37%. In Singapore, around 29%. In Dubai, the city is essentially a service environment staffed entirely by people who came for the opportunity and retained the option to leave. That option was exercised at speed. Within 48 hours of the first strikes, charter brokers reported complete sellouts across all available aircraft departing the Gulf. Iran's attacks sparked a rush to airports and panic buying in some supermarkets. British teachers, American bankers, German engineers, and South Asian construction managers all converged on the same calculation simultaneously: wait for clarity or go. The Palm Jumeirah, usually a tableau of luxury indifference, went quiet. The brunch venues closed. Former JP Morgan chief strategist Marko Kolanovic warned that with 88% expats, tourism, finance, air and shipping exposure combined, this situation could send shockwaves globally. The 20-year safety myth had not just sold Thomas on a property investment, it had sold a city's entire economic identity to the world's most mobile population. And that population, by definition, could move. The question Thomas was now asking himself, standing in that queue, was not whether to leave. It was whether the market he had locked his money inside could survive without him. The answer, it turned out, was more complicated than a simple yes or no. Because on paper, the prices looked fine. And that, more than anything else in this story, was the most dangerous illusion of all. If you checked Dubai apartment prices in the first 2 weeks of March 2026, you would have found something deeply confusing. Median prices per square foot had barely moved. The headline number pointed to a decline of roughly 3% year on year, not a crash, a shrug. And for a moment, the narrative survived. Prices were holding. The market was resilient. But there is a word for a market where prices stay flat and transaction volumes collapse simultaneously. That word is frozen. Goldman Sachs reported that transaction values collapsed 51% month on month in the first half of March. The DFM real estate index fell approximately 21% in the 2 weeks following the Iranian strikes on UAE soil, yet median apartment prices per square foot declined only 3% year on year. The reason is behavioural, not structural. In a freeze, sellers refuse to accept the reality of impairment. They would rather remove their listing than reduce their price. Buyers, equally uncertain, would rather wait than overpay into a conflict zone. So the two sides simply stop transacting, and the headline price, built from a shrinking pool of deals that do close, becomes a statistical illusion. Thomas knew his deposit was technically intact. What he could not know was whether it was real. A frozen market does not tell you what your asset is worth. It tells you what the last desperate or uninformed transaction agreed to pay. That is not a valuation. That is a ghost. To understand why the frozen market is so dangerous, you need to understand the specific mechanism on which Dubai had built its latest boom. Off-plan transactions accounted for 65% of total transaction volume in 2025, marking the third consecutive year that off-plan led Dubai's residential market. The model worked brilliantly in a rising market with continuous inbound demand. A buyer commits a deposit, pays in installments over the construction cycle, and benefits from capital appreciation before the building is even finished. Developers use the deposit stream to finance construction. It is elegant, efficient, and entirely dependent on one thing: the next buyer. Approximately 366,000 residential units are expected to enter the market through 2028, with the majority phased for delivery in 2026 and 2027. This was already a supply wave that analysts had flagged as potentially market softening, even before a single missile had been fired. Fitch Ratings had warned in May 2025 of a correction of up to 15%, driven by projected unit deliveries. After the conflict broke out, Citi slashed its Dubai population growth forecast from 4% to 1% for 2026, materially impairing the demand assumptions underpinning every off-plan model in the city. Thomas had 4 deposits across 4 developments. Each one was a bet that a foreign buyer, motivated and solvent, would show up on the other side of completion. That buyer, statistically, was likely standing in a queue at Terminal 3 right now, reconsidering everything. And here is the thing about a time bomb: it does not care whether you're watching it. But before this detonates, there is one cushion separating Dubai 2026 from Dubai 2008. Whether that cushion holds may be the most consequential financial question in the Middle East right now. In 2008, Dubai's real estate collapse arrived with a mechanism the market had borrowed from the West: leverage. Mortgages had been extended on loose terms, buyers were overcommitted, and when demand evaporated, forced selling cascaded through the system like a structural failure rather than an orderly retreat. Prices fell between 50% and 60% from peak to trough. The city took years to recover. The 2026 iteration of this crisis is structurally different. 87% of Dubai property purchases in 2025 were cash transactions, eliminating the forced liquidation cascades of 2009. UAE bank real estate lending fell to 14% of gross loans at end 2024, down from 20% at end 2021. There are no margin calls forcing distressed sellers to the market, no banks calling in loans. Without that mechanism, the immediate violent liquidation of 2008 cannot replicate itself. This is not a cliff. It is, for now, a ledge. But a ledge and a cliff share a key feature. The drop below them is identical. The danger is duration. Every analyst studying this situation arrives at the same pivot point: summer. If the conflict grinds past June without resolution, the behavioural economics shift fundamentally. Off-plan buyers waiting for clarity will begin to calculate whether abandoning a deposit is cheaper than completing a purchase in an uncertain market. Legally, off-plan contracts make that painful. Psychologically, at a certain point, the pain of staying exceeds the cost of leaving. That moment, if it arrives, is when the cash cushion becomes irrelevant and the cliff becomes visible. The story does not stay in Dubai, it never did. Because the capital that built this city did not sit still either. And that capital was not small. The GCC's largest sovereign wealth funds, including Abu Dhabi's ADIA, Mubadala, the Kuwait Investment Authority, the Qatar Investment Authority, and Saudi Arabia's Public Investment Fund, deployed $119 billion in 2025, an increase of 43% on the previous year. Coupled with pension funds, central banks, and state-owned investors, total assets reached an aggregated $60 trillion. The United States absorbed 47% of all sovereign investments in 2025. This capital had built deep structural positions across the architecture of the new economy. AI chip supply chains are routed through agreements with American semiconductor giants. Boeing aircraft orders underpin fleet expansion plans for Gulf carriers. European data center investments are tied directly to the digital infrastructure build-out of the 2020s. These were not speculative positions. They were long-term strategic bets on the stability of a global order that assumed the Gulf would remain open for business. The war changed the calculus. Gulf funds began freezing new commitments. Boards in Riyadh and Abu Dhabi postponed allocation decisions. The $6 trillion was not fleeing, but it was waiting, and the capital that is waiting is not being deployed. And capital that is not being deployed is not building the economy it was meant to build. The waiting was about to become a problem for people who had never heard of the Strait of Hormuz. Because the oil shock that started in the Gulf was now repricing everything, everywhere, at once. The Federal Reserve Bank of Dallas had run the model. It was not speculative. A closure of the Strait of Hormuz, removing close to 20% of global oil supplies, would raise the WTI price of oil to $98 per barrel and lower global real GDP growth by an annualized 2.9 percentage points within a single quarter. Extend the closure to 3 quarters, and the oil price would reach $132 a barrel before it peaked, with the impact on global growth remaining negative through year-end. The Dubai benchmark crude, tracking actual Gulf deliveries, surged 76% since the war began, reaching roughly $126 a barrel, more than double the gain in Brent paper futures. Goldman Sachs, in its weekly economics update, raised its recession probability for the United States to 30%, lifting its inflation forecast to 3.1% PCE by December, and cutting full-year GDP growth to 2.1%. A 30% recession probability is not a tail risk. It is a 1 in 3 chance that the world's largest economy contracts. Economists at EY Parthenon put the probability of a severe US downturn at 40%, up from 35% before the conflict began. Goldman calculated that every 10% increase in crude adds approximately 0.2 percentage points to inflation, while trimming economic growth by roughly 0.1 points. The math was compounding in the wrong direction. The shockwaves Thomas had spent 20 years ignoring were now arriving in New York, Frankfurt, and Tokyo simultaneously. There is a historical document every Dubai real estate investor should read before they sleep tonight. It is the price chart from 2008 to 2011. At the peak of the pre-crisis boom, Dubai's property market had appreciated explosively, fed by leverage, by foreign capital, and by the same narrative of permanent exceptionalism that defined the 2024 cycle. Then, the music stopped. Between 2008 and 2011, prices fell between 50% and 60% from their peak. Not in the peripheral markets, in the prime ones. The defenders of the current market will point correctly to the cash buffer. They will note the regulatory improvements, the RERA oversight, the OCUD registration, and the escrow accounts protecting off-plan deposits. They're right about all of it. These are genuine structural improvements. They prevent a systemic meltdown. They do not prevent a 25% to 40% correction if the conflict extends past summer and population growth falls to the 1% that City now projects against the 34,000 unit annual delivery pipeline. The luxury segment carries a specific vulnerability that the mid-market does not. The buyers of penthouses and waterfront villas at 3,000 dirhams per square foot are, by definition, globally mobile. A British hedge fund manager who bought in Business Bay can, within 72 hours, redirect his capital toward a comparable lifestyle in Singapore. Singapore does not sit beside a conflict zone. It does not depend on a strait that another country can close. The 50 to 60% collapse scenario is not a prediction. But a market built on the world's most mobile capital is exactly the market most capable of producing one. Thomas eventually made it onto a charter flight. He was fortunate. He had a British passport, a valid credit card, and the kind of network that found seats on aircraft that did not officially exist on a booking platform. He left Dubai at 2 a.m. on the 3rd of March with nothing resolved and everything questioned. The deposits were still live, the developments were still under construction, the off-plan contracts were still legally binding. None of those facts had changed. What had changed was the assumption underneath all of them, the one thing that nobody had priced into any model, written into any prospectus, or mentioned in any broker presentation. The assumption was that Dubai was categorically different. That geography, that proximity to conflict, that 90% foreign population, that total dependence on a 14-mile strait for its economic oxygen, none of it applied to this particular city because this particular city had decided it did not. The lesson of February 28th is not that Dubai is finished. It may well recover. Conflicts end. Capital is patient. But the lesson is this: different is not the same as immune. Every haven in history has carried a version of the same pitch, but here, uniquely, the normal rules do not apply. History has never once validated that claim permanently. So here is the question Thomas is sitting with now, somewhere above the Mediterranean, staring at a screen full of positions he can no longer access. If not Dubai, where does the capital go next? And whatever city answers that question first, whatever skyline steps forward and offers the same guarantee of permanent safety, the same promise of immunity from geography, you already know what to ask them. What are they not telling you about where they are built? If this story changed how you think about where money hides when the world gets unstable, there is one thing you can do right now that costs you nothing. Hit the subscribe button. Because this channel exists for exactly this kind of analysis. The capital flows, the geographic fault lines, and the markets that look safe until the moment they do not.